Welcome to this week's episode of the Modern Sense Minute. I'm your host, Andrea Thompson. What caught my eye this week is an article in the Globe and Mail titled Almost 10% of Toronto mortgage holders won't qualify to refinance next year, the Bank of Canada says. The gist of the article goes on to say that nearly 1 in 10 mortgage holders in the Toronto area won't be able to refinance their loans or renew them with a new lender in 2027. This is more of a 4% level nationally. So, what does that mean for people who may be affected by this? Number one, if you are looking to take more equity out of your home, let's say to pay off other debts, or you maybe need to access equity for cash flow purposes, that might not be possible to be able to restructure your debt in order to do that because you have less equity in your home. As well, there's other ways to refinance to be able to access more equity, which is called increasing the amortization of the mortgage. Or if you want to renew your mortgage with a different lender, so if you don't like the bank or the credit union that you're currently with and you want to go somewhere else and shop around, that might also not be possible. So, what this could mean is that people have less options when it comes to renewal as to how they continue to carry their mortgage, and less options for being able to pull debt out if they need to access it for other purposes. Now, if you have a mortgage with a lender and you're satisfied with your existing lender and you're coming to the end of the term, fear not. You can likely and usually always still refinance your existing mortgage with the same lender and just renegotiate the terms of that. So, whether it be I'm going to go into a new 5-year fixed or a 3-year variable or whatever it is that you decide to do, you can do that with the same lender that you are currently with most of the time. So, what can we do about this? And this is something that I have seen with clients now for probably for the past 2 to 3 years as they're coming up for renewal and they're really stressed about whether or not they're going to be able to continue to qualify or afford the new mortgage payment, knowing that interest rates are higher and also property prices are depressed. So, what can you do? Number one thing is get ahead of it. So, going and speaking with your mortgage professional and understanding your range of options for when renewal is eventually coming up is a great idea. Demystifying that particular element of mortgage planning and understanding what options are available to you could be really beneficial. As well, if you do a pre-qualification, often you can lock in a specific rate for a period of time before you renew if you work with that particular lender. Second is you can understand the cash flow implications of the new mortgage. So, where people get stressed sometimes is thinking, oh my gosh, I'm not going to be able to afford my mortgage when it renews. So, to help you with this, we've actually built a calculator for our clients to use and actually anyone to use. It's available on our website in the tools section, and it helps you understand number one, what is going to be my mortgage balance at the end of my term? And then number two, if that was going to roll over into a new mortgage, what are the cash flow implications of that? So, for example, if you're working with a mortgage agent and you're getting ahead of understanding your options for your new mortgage. So, if let's say it's a 3-year term or a 5-year term, they'll usually give you a rate. What you can do with the calculator is input those details. Let's say you get a couple different rates and you're not sure which option to explore, and you can put them into the calculator based on the balance at the end of your existing term. And then it will show you here are the payments that you can expect. Here is the projected balance at the end of your new term. And you can compare them to each other. So again, if your mortgage broker gives you a couple different rates, you can contrast and compare them in this calculator to really understand your cash flow implications. Now, that doesn't really solve the innate problem of not being able to refinance with a new lender or not being able to take equity out. But what it can do is help you understand that if you stay with your existing lender, how does that affect your cash flow going forward? Which is often the most concerning element for most clients that I talk to is they think that their payment is going to increase substantially. But what I do want to remind everyone of is that you have been paying down your principal over your existing term, and therefore the implications of an increased interest rate may not be as dire as you think that they may be. So again, running the numbers in advance and really understanding what that may look like upon renewal is really important and key and may help you to better understand your cash flow once the renewal comes up. So that's it for this week on the Modern Sense Minute. Again, you can go to our website. I'll put a link in the show notes here for you to check it out. And just understand your options. Speak with your mortgage agent or your brokerage as soon as possible if you're coming up within 6 months of a renewal. Understand your options, understand your mortgage structure, what's available, and plan ahead. With that being said, have a great rest of your week, and we'll talk to you next week.